Hello and welcome. You're watching us at the Private Banking Congress in Hamburg. With us today is Sagar Thanki, Portfolio Manager of the Guinness Global Innovators Fund. Sagar, nice to meet you and have you here.
Likewise.
Our first question, what are the arguments from a growth strategy like your fund follows in the current circumstances?
So in the Guinness Global Innovators Fund, we focus on companies that can maintain a high return on capital as they grow. So there are 4 pillars to the strategy. We start off by looking at companies exposed to secular growth, and that forms the initial part of our investment universe. We then overlay a quality criteria because we're looking for those companies that are profitable, that have competitive advantages and a wide moat. And we're looking for these sorts of companies at attractive valuations. So there's a strong valuation discipline. We're not looking to overpay for future growth or overpay for significant uncertainty in that growth. And we package that up into a high conviction portfolio of 30 stocks which are fully invested and equally weighted as well.
What can you tell us about the fund's performance and what investors can expect?
Absolutely. So performance is really, really strong. The fund launched in 2000, or the strategy at least, launched in 2003. And over that period, we've returned almost 1,200%, which is double what the MSCI World has returned. Even over 15 years, 10 years, performance is about double that of the MSCI World. And what's quite interesting is that the beta of the fund is just less than 1.2. So we typically expect the fund to outperform in rising markets. However, the fund does not tend to fall as much in a falling market. So there's an asymmetric skew to that rising market.
Mm-hmm. And how do you exactly allocate the stocks in your portfolio? It's very concentrated.
Yeah.
What is your exact strategy to choose?
So the entire stock selection process is bottom-up, fundamentally driven. We're looking at companies based on their quality, their growth, their valuation characteristics. We run a quantitative screen, we run a qualitative assessment to really understand these companies because it's only 30 best ideas and we're looking to hold these companies for a long term, for at least a 3 to 5 year investment horizon.
Are there any sectors or regions that you are currently not investing in or avoiding a too big allocation?
Sure. So by nature of our universe criteria, whereby we start off by looking at companies exposed to secular growth themes such as AI, healthcare, robotics and automation, cloud computing, that takes us away from some of the more capex heavy and regulated industries. So energy, materials, utilities, real estate, these tend to be more commoditized or regulated areas of the market that don't really show up in our initial investment universe. So that takes us away from many of those sectors. There is a bias, perhaps as you would more naturally expect, to IT, industrials, consumers, healthcare and financials.
Mm-hmm. And what market conditions do you expect in the future? And with regard to the geopolitical environment, what are your expectations?
So I think at the moment markets have been focused on essentially the 3 T's: Trump, tariffs, trade. And Trump is essentially trying to address the US trade deficit because over the last 30 years, the import of goods has exponentially increased and the increase in services exported in the US has not kept up proportionally. So there's a widening trade deficit. He's trying to correct that via tariffs and trying to agree to a number of trade deals. And that's created a lot of uncertainty for corporations and investors. And we believe that there are three order of effects with regards to what's going on with tariffs and trade and Trump at the moment. Number one is the uncertainty of, are tariffs that are imposed today going to still be there next week? Are there higher import costs in the short term and the long term? Will there be any retaliation? The second order effects focus more on how is this going to impact GDP growth? How is this going to impact investment, jobs, and the uncertainty related to that? And then longer term, we believe that it could have an effect on profitability, on longer term investment decisions, on capital allocation, and also where global supply chains are maneuvered to in order to perhaps avoid some of these tariffs.
Could you outline how will this affect on value appreciation and volatility?
Yeah, so what we've seen this year is at the start of the year there was initially increased volatility as markets had uncertainty with regards to tariff rates, who they would be imposed on and to what levels. That subsequently has come down quite significantly as markets have now been focusing on US interest rates, and there is an expectation that those will fall, but whether there's a 25 basis point cut or a 50 basis point cut over the next few months is still up for question. Those sorts of events are creating market volatility, but underlying that, that's been tempered by strong earnings season in the US and the fact that corporations are still reinvesting, particularly in R&D and CapEx, and fueling some of those secular growth themes like AI.
Mm-hmm. Thank you very much for your detailed insights.
No problem. Thank you very much.
Thank you very much for joining us today. See you next time. Goodbye.